Welcome back. In this lecture, we will be exploring the real rate of return, definition, applications, and illustrative example. As we explore this topic, it's important to have a clear understanding of what we mean by the real rate of return. This financial terminology is an essential concept in the world of investments and economics. It is a fundamental term that every investor, economist, and financial analyst should understand and use in their decision-making process. Before going into the definition of the real rate of return, it is helpful to understand why it is essential. Investing is all about making your money work for you. It's about putting your hard-earned cash into avenues that will yield more money with time. However, there exists a hidden enemy that erodes the value of money over time: inflation. Inflation is a rise in the level of prices of goods and services in an economy over a period. As inflation increases, the purchasing power of a unit of currency falls. Essentially, with inflation, your money buys than it did before. The real rate of return is calculated using a simple formula: the nominal rate of return minus the inflation rate. The nominal rate of return is the amount of money generated by an investment before factoring in costs such as inflation. By subtracting the rate of inflation, we're left with the real rate of return, which tells us how much our investment has truly grown in value. In the following sections of this lecture, we will look at illustrative examples that will help solidify our understanding of the real rate of return. These examples will demonstrate its calculation and its practical application in various financial scenarios. So stay tuned as we explore this intriguing concept in greater depth. Now let us explore how it's used. Accurate assessment of investment performance. The real rate of return allows investors to accurately assess the true profitability of their investments by considering the impact of inflation. It provides a more realistic measure of investment performance, enabling investors to make informed decisions. Comparison of investment options. Investors can use the real rate of return to compare the relative attractiveness of different investment options. By adjusting for inflation, investors can determine which investment offers the highest real return, considering both nominal returns and purchasing power. Planning for future financial goals. Financial planners and individuals use the real rate of return to forecast future investment growth and plan for long-term financial goals. By factoring in inflation, investors can ensure that their investment returns will maintain or increase their purchasing power over time. Let me give an example of real rate of return calculation. Please let's be attentive. I will as well show the workings to our screen. Suppose an investor purchases a bond with a nominal return of 7% per year. During the same period, the inflation rate is 3%. To calculate the real rate of return, now let's work it. Real rate of return equals nominal rate of returns divided by 1 plus inflation minus 1. Real rate of return equals 0.07 divided by 1 plus 0.03 minus 1. Real rate of return equals 0.07 divided by 1.03 minus 1. Real rate of return equals 0.06796 minus 1 divided by 1. I hope we understand the simple workings. Now, in this example, the real rate of return on the bond investment is approximately 3.7%, indicating the actual increase in purchasing power after accounting for inflation. I must tell you, the real rate of return is a vital metric for investors seeking to accurately assess the profitability of their investments and plan for future financial goals. Thanks for watching. Stay tuned for next class. Do not forget to like, comment, and subscribe.